Hello, and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Well, hey there, Michelle. How's it going?
Hey, Wendy. It's going well. We just finished our latest set of retirement classes that I taught at Houston Community College this past month. So
Okay.
that was fun. Yeah, we had a few things going on.
Is that like a class or just like something you go in as like a service?
Well, it's an adult education class that's held in the evening, but it's not, we are not affiliated with Houston Community College. So it's
Okay.
not part of their curriculum.
Gotcha. But you gave all the people the knowledge that they need.
I give a portion of the knowledge that they need. I do my best.
Okay. So, what are we going to be talking about today?
Well, earlier, episode 21 was about Social Security filing strategies. And I mentioned that we are going to have a follow up Social Security episode that give tips about, well, that explain, I should say, how benefits are taxed. And so that's what we're going to talk about today is how are your Social Security benefits taxed? And why would we want to do that? Because if you understand how your benefits are taxed, you may be able to make some changes. And I like to say, he or she who understands the rules of the game has a better chance of winning the game.
I like that. So, what's the first thing we need to know?
All right, so let me set the stage. You work hard, you earn money, you pay your income tax, you see on your pay stub that your earned income is also subject to FICA, which is a federal payroll tax. And this tax is currently 7.65%. That includes the Medicare tax paid by the employee and another 7.65% paid by the employer. Now, if you're a business owner that is not set up as an S Corp, you're going to pay both sides. Now, fast forward to when you retire and you start collecting your Social Security benefits, whether at age 62, 66, 67, or 70. Now you're looking forward to receiving the benefits that you paid taxes on for all of these years.
So these benefits come to you tax free, right? I mean, we've paid the FICA, right? Who's the FICA guy?
That's what you might think, but the answer is not necessarily. Now, it's worth noting that your Social Security benefits were completely income tax free at the federal level up until the year 1984. But since then, taxes on Social Security benefits were set up, and there was an additional change made in 1993. So I'm going to explain how this works. Social Security benefits follow their own income brackets to determine how they're taxed, similar to income tax brackets, but they're different brackets. Right now, no more than 85% of your Social Security benefits are subject to income tax. But these income brackets for Social Security taxes are different, as I said, different from the regular income tax brackets, and they have not been updated for inflation since 1993. So, first, what you need to know is what provisional income is before we can talk about how your benefits are taxed.
Okay, so hit me with the provisional income.
All right, provisional income is a term that you will want to know. It's not your adjusted gross income. It's not modified adjusted gross income. It's not even your earned income. Provisional income is very specific. As I said, it only applies to Social Security. So to calculate it, first you have to total up all of your earned income, if you have any, all of your traditional IRA withdrawals, your regular interest and dividend income, your pension benefits if you're so lucky to get them, any rental income, and even your tax exempt income from municipal bonds. Then you also have to add in 1/2 of your Social Security benefits to this total. Now you have what's called provisional income. Now, I don't know if you noticed, but I mentioned you are including tax exempt interest income from your municipal bonds. So that surprises people because people think, well, it's tax exempt income, so it shouldn't be included, but it is here in this calculation. And you have to also add in half of those Social Security benefits themselves.
So this is what's good about the Roth IRA, right? So the taxes are already paid on all of those, right?
Yeah, and I want to specifically point out Roth IRA withdrawals are not included. So that's a good catch that you mentioned that. I mentioned withdrawals from regular IRAs, but not Roth IRAs. Those do not get factored into this provisional income equation. So anything Roth IRAs, Roth conversion accounts, none of those cause your social security benefits to be taxed because those withdrawals are excluded from provisional income. So now comes the fun part, finding where you land in the Social Security income brackets to determine whether or not your benefits are going to be taxed. So first off, there's a base amount of provisional income that allows you to be completely free of any tax on your Social Security benefits. For married people, your provisional income must be below $32,000 for the entire year so that if you don't want to have taxes assessed on your benefits. For single people, it's under 25,000. So if your provisional income is below these amounts, you would pay zero tax on your benefits. If your provisional income is between 32,000 to 44,000 as a married person, or between 25,000 and 34,000 as a single person, then half of your Social Security benefits will be subject to federal income tax. And anything above 44,000 for the year as a married person, or above 34,000 as a single person, then 85% of your Social Security benefits will be taxed. But there is no scenario where 100% of your Social Security benefits are taxed at the federal level.
So if all I need in addition to the Social Security benefits that my spouse are receiving is an additional $32,000 from separate accounts, excluding the Roth, then I won't have to pay any taxes on the Social Security.
I think so. Let me just make sure I understand your question. So you're a
Okay.
married person.
Yep.
And you added up what I defined as provisional income, and it's less than 32,000, then you're not paying tax on your Social Security.
Okay. So and again, just to reconfirm, Social Security is not part of the provisional income.
It is.
Oh, it
So
is.
yeah. So remember, provisional income, I was rattling off all these things that you have to add up. And one of the items that goes in there is half the benefits themselves.
Okay, half the benefits.
Mm-hmm.
Okay, gotcha.
Which surprises people.
Because it kind of stinks.
It kind of does. And you know what else stinks is that these thresholds have not gone up because of inflation. And usually brackets are an index for inflation. These have not gone up since
Right. So they need to.
Well, they really do. They're quite low.
I agree. So what's the big takeaway here then?
So what I want our listeners to notice is that if you're able to keep your income that counts as provisional income on the low side, then your Social Security benefits will not be taxed. If you're able to shift a lot of your money over to Roth accounts, then it's possible that you would pay no federal income tax on your Social Security benefits. Now, of course, this is easier said than done. If you're late to the tax planning party, well, then you may not have been able to get your tax diversification done, shifting a lot of your money over to Roth. For example, if you receive a lifetime stream of pension income, there's not much you can do about it. It's a good problem to have, but it's still a problem.
Right.
So if you are, well, let's just say you're about to retire and you have a choice of either taking that lifetime stream of income as a pension, or you can do the pension as a lump sum that they roll into an IRA for you. You could decide to take the lump sum and then convert that money to Roth so that you have a better chance of lowering your provisional income. Because once it's a lifetime stream of income, well, there's nothing to convert. Now, if you still want a lifetime stream of income, you could then take that lump sum that's now an IRA, convert it to Roth, and then take that Roth money and purchase yourself an annuity, which is what a pension is. And that's what a pension uses to give you those lifetime payments. But now the lifetime payments are income tax free. Now, I'm I'm not suggesting that you should always take the lump sum. I say this with a warning because you will want to make sure that the lump sum option is the better option from more than just a tax standpoint, which takes a professional review from your financial planner.
And I have another question.
Sure.
If you take the lump sum option, does that mean you have to pay all the taxes on it that year?
That's a great question. No, because you'll have it done the right way. You will have it rolled into an IRA. So the pension comes from an institution and you're having them roll it over into an IRA that is set up at another institution. So it's a trustee to trustee transfer, which is not a taxable event.
But if you're rolling it into a Roth, then you will have to pay taxes.
That's right. So you could decide to just leave it as an IRA, but if you want to convert some of it to a Roth, maybe it's not all or nothing. Maybe you convert some of it to Roth, maybe not. I mean, this is all part of the analysis that you would have with a professional. But I'm just saying, you don't have to take your pension as a lifetime stream of income. If you do, well, you can't convert any of that, and it's always going to be taxable income that could raise that provisional income we were just talking about.
So, how does all of that Social Security tax add up over the years if you were not able to shift a lot of it to Roth accounts?
Yeah, another good question. So let's look at an example that I can give you, one that I often give in my retirement classes to answer that. So let's say we have a couple, uh, we'll call them Bill and Jane, and they're retired. And let's say that we added up everything that Bill and Jane have as provisional income, and it totals up to be $125,000 a year. Now, clearly, they're over that $44,000 mark, which means that 85% of their Social Security benefits will be taxable. Now, their federal marginal tax bracket is 22%. And let's say their total gross Social Security between the two of them adds up to 35,000, which is already part of that 125,000. All right, so 85% of 35,000 is 29,750, $29,750. And let's say, to keep it simple, that the tax owed on their Social Security benefits is that 22% marginal tax rate that I mentioned. So 22% of 29,750 is $6,545. That's what Bill and Jane will owe in tax on their Social Security benefits that they had for the year, which were gross $35,000. Now, for my listeners who are tech savvy and tax savvy, you might think, well, they're not going to pay exactly 22%. Well, we're going to use 22% in my example, just so it's to keep it simple, but the concept still remains. So let's use 22% for this example. So with $6,545 that they have to pay back, that's the tax due on their Social Security. That means Bill and Jane must dip into their accounts to pay it at tax time. So this can be a problem because most people keep their retirement money in IRA accounts, right? Most people don't have Roth IRAs or much of a Roth IRA. So now our fictional couple, Bill and Jane, must withdraw more than $6,545 to get the amount that they need, because now they're triggering more tax when they withdraw from an IRA, and they have to withhold federal income tax for that withdrawal, and maybe even some state tax if they live in a state with state income tax. So now, to get the $6,545 to pay back to Social Security on their tax return, they have to withdraw $8,391 at a 22%, income bracket, just to pay the $6,545. So you can see it starts really adding up. And if they're doing this every single year, that $8,391 is money that is not invested in the market and not earning a return. Now, if you would like to know the opportunity cost of having to do this every year, pulling out that money to pay back the taxes on your benefits, if you do the math and you want to see what the lost return adds up to, This is an annual $8,391 withdrawal over 20 years, let's just say 8% return. That's a whopping $423,099. And we're not even factoring in that Bill and Jane are going to get a cost of living increase on their benefits every year.
Well, I don't like that at all, Michelle.
I don't either.
Well, let me ask you this question. I'm not a good numbers person, so I'm a little confused as to why we're taking out 8391 when we need 6545.
Yeah. Well, that's because you're taking it out of an IRA. And remember what happens anytime you make a withdrawal from an IRA. You got to pay tax on that, right? Because that money's never been taxed. So now you got to withhold some money for that just to get your 6,545. And I did the math. So I had to gross it up. So 8,391 is what it worked out to be, where 22% goes to the IRS and you get to keep the 6,545.
Sometimes I just have to hear it a couple of times before it sinks in, Michelle. So
No,
thank you.
it's kind of, people don't think about this, but it's kind of complicated.
It's
Yeah.
tricky.
Yeah. But now if Bill and Jane had withdrawn from a Roth account, there would have been no tax implication there.
And then they would have just needed the 6545.
Correct. That's
Okay.
right.
So is there anything that we can do to try and make this a better situation?
Yes, potentially for some people there is. I want you to understand that proper tax planning, which may include these Roth conversions I'm always talking about, spread over several years at a reasonable level, the right amount for you, which is different for everybody, that can help save you on your Social Security taxes as well. You may never be able to get to this zero bracket that I've been talking about for Social Security taxation, but at least you can lower perhaps your provisional income number, and that's the number that triggers this Social Security tax, which could then put you in a lower bracket for Social Security taxes. Maybe you'll be in the 50% threshold rather than the 85% threshold, if not the zero threshold. And lowering this Social Security taxation means more money in your pocket, which could add some years to your retirement assets.
So what should people do?
Well, I'm a big fan of tax planning, and it's just not that simple. When someone talks to their CPA, let's just say, and CPA says, "Oh, well, you're old, so you won't live to see the benefits of a Roth conversion." It's just so much more complicated than that. Um, so I recommend that people who want to take a look at this, review your assets with a certified financial planner who does this kind of tax planning, like our office, because the tax planning has a lot of benefits, some of which can be realized during your lifetime, and some that can only be realized for your heirs. And this Social Security taxation doesn't even get thought about uh, most of the time, but now you see it also has an impact. So your tax advisor may not do this type of tax planning. Most don't, because there's scenario analysis, there's projections that have to be taken into context with all of your financial planning. And CPAs typically just look at the here and now. So, if you needed another reason to get your tax planning and your comprehensive financial planning done, this would be another one, another reason to do your tax planning with a qualified CFP professional.
So how early should we do this before retirement? When should we start thinking about this on an annual basis leading up to retirement?
As early as possible. The more time you have, the more impact you can make, and we can maybe do it slowly over time. But I also like to say, if you're listening to this and you're already drawing Social Security and you're already in retirement, it's not too late, because um, we are in a historically low tax rate environment, at least for the next 2 years. We don't know what Congress is going to do when current tax rates sunset at the end of 2025. We don't know. Are they going to stay the same? Are they going to extend what we are enjoying right now? Are they going to raise taxes? We don't know. But we still have 2024 and 2025 to make a difference. And let's just say those rates get extended, well, then you have even more time. There's always something that can be done, whether it's this or something else.
Okay. I'm a big fan of the Roth. I really want to, and I don't have one, but I'd like
Mhm.
to get one. I have a regular IRA. Just I want to kind of turn that over, but then I have to pay the taxes on it.
Yeah, that's the thing. You know what? It's pay now or pay later.
Right.
At least if you're paying now, you're doing it in a managed and controlled way at historically low tax rates. You know what the rates are, they're where they are right now, and do what you can. And here's the thing, whatever you can afford to do, because you will have to pay the taxes on whatever you convert, all the growth from here on out on that money that you converted belongs 100% to you, all of it. And it's not going to trigger Social Security taxation down the road.
Okay. I'm going to do it, Michelle. I'm going to pull the trigger.
Well,
Yay.
good. Yeah, no, it's good to at least look at. It may not be right for you. It may not be right for somebody else, but you should at least look at it. Have it looked at before you make a decision.
Okay. So, Michelle, if people have some more questions about this, is this something they can come to you for? And if so,
Absolutely.
how do they get in touch with you?
Yeah, this is what we do. This is a big part of what we do. So absolutely reach out. The easiest way to remember how to get to us, I mean, I could rattle off a phone number, but you're better off just visiting our website, gessnerwealthstrategies.com.
Well, thank you, Michelle, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.